After the Federal Reserve began cutting interest rates in September, we've seen mortgage rates do the opposite and head higher, putting the housing market in an even tighter spot. In today's video, we're going to look at the prevailing theories as to why this is happening. Some aren't so bad, but some of them could mean big trouble down the road. Let's get into it. The Federal Reserve began cutting their Fed funds rate at their September meeting, starting off with a big 50 basis point cut. And they followed through on that with a 25 basis point cut at their November meeting. It also seems likely they will cut another 25 basis points at their December meeting. It's the dream scenario we had been waiting for, with the hope that it would lead to lower mortgage rates and give a boost for the housing market. But instead, mortgage rates have done the opposite and headed higher. As of December 5th, the average 30-year fixed-rate mortgage was 6.69%, a sharp increase from the low point of 6.0% on September 26th. Why are mortgage rates going up? Like I pointed out in multiple videos, you can blame the bond market for that. The yield on the 10-year Treasury bond, which the 30-year mortgage tracks very closely, has been going up since the Fed started cutting rates. As of the close of trading on December 9th, the 10-year yield was at 4.19%, up from the low of 3.62% on September 16th. And now for the million-dollar question. If the Fed is cutting their Fed funds rate, why is the bond market sending the 10-year Treasury bond yield higher? And for some people, that literally is a million-dollar question. There are several theories out there, and we're going to look at each one. I'll start with the most innocent explanations and work our way up to those that are downright concerning. Now, on this channel, I try to stick to analysis of the data and present findings that I can back up. I don't find speculation and doomsday predictions to get people to watch my videos very useful, so that isn't what I'm trying to do here. But as we make our way through these theories, there is going to be some speculation, just because no one knows for sure what's going on, and there will be a bit of doom and gloom at the end. Okay, for the first theory, and this is something I've thought of, is that we're just looking at normal short-term market volatility as bond traders adjust to a new interest rate environment. Sure, we've seen rates go up over the last month or so, but when we zoom out to look at the history of the Treasury yield, there are plenty of points of volatility that are in line with what we're looking at now. Another important point we can learn from looking at the 10-year Treasury historically is that it follows the history of the Fed funds rate over time. Just looking at this historical correlation of the Fed funds rate and 10-year Treasury over time, it's not unreasonable to think that we are just going through a period of short-term volatility as the bond market adjusts to a new interest rate environment. And if the Fed continues to cut the Fed funds rate to support the economy, then we should eventually see the 10-year Treasury yield and subsequently mortgage rates start to come down. In this theory, we just need to sit tight as the market works things out as it historically has, and then we should see lower mortgage rates in time. This is the most innocent explanation for what's happening. For the next theory, the recent strength in economic performance has to be considered. Let's take the jobs market as an example. In both September and November, we saw job creation come in way above expectations and recent trends, showing the labor market is still running strong. Outside of the labor market, the overall economy is doing well also. Third quarter real GDP growth came in at 2.8% on a seasonally adjusted annualized basis, down slightly from the 3% in the second quarter, but a respectable growth rate nonetheless. The idea with this second theory is that the economy was strong enough that the Fed didn't need to start cutting rates, and that they might not cut as much as originally anticipated because the economy doesn't need the support. Alternatively, the Fed might even need to raise rates next year if the economy heats up more and inflation starts to tick up again. Remember, the bond market is forward-looking, and the drop we saw in the 10-year yield and mortgage rates in the lead-up to the Fed's September meeting likely priced in more Fed rate cuts than the market now sees the Fed making, given the economic strength since that September meeting. In this theory, the yield on the 10-year Treasury would be unlikely to go below that low point of 3.8% we saw back in September, just before the Fed meeting. And if that is the case, then the average 30-year fixed-rate mortgage is unlikely to go below its September low of 6.1% anytime soon either. For this second theory, we have to wait things out and see how the economy and inflation trend next year. This now brings us to the third theory, and this is the one that troubles me the most. In the lead up to the November presidential election, there was more attention than usual on the U.S. budget deficit and overall government debt. For those of you who don't follow it, the U.S. government runs huge budget deficits, and they are regularly in the trillions of dollars now. In order to fund the deficit to maintain government spending, the U.S. Treasury sells Treasury notes, bills, and bonds to make up the difference. Over time, this has led to a massive government debt, which is currently over $36 trillion. When the government sells debt to finance the deficit, they do it in an auction. The Treasury Department doesn't set what the yield will be on those bonds. The bond market sets the yield based on who is willing to buy and at what price. Here's where this gets troubling. If the bond market is starting to get worried about the sustainability of growing budget deficits and financing them with government debt, they will demand a higher yield in those Treasury auctions in order to offset the future risk of the government not being able to pay the bondholders when the Treasury note, bill, or bond matures. A higher yield on a Treasury bond means the government has to pay more interest over time. In September, it was reported that the U.S. government paid over $1 trillion in interest for the first time. That is a huge part of the budget going just to interest payments. To put that into perspective, that is more money than the entire U.S. military budget, and we spend a lot on our military. In 2023, the Defense Department budget was about $820 billion. Now the U.S. government is unlikely to ever default on a bond payment because the debt is denominated in U.S. dollars. In the worst case, we could just print the money to pay the bonds. But if we're just printing money to pay our bills, all faith in the U.S. dollar will evaporate and people will stop buying treasuries unless the yield is really high, and then we just have to print more money to keep the government running. This is a nightmare scenario because it would mean that the dollar would lose its status as the world's reserve currency, and other countries would be racing to get rid of the dollars they have, which would then lead to a severe devaluing of the U.S. dollar. Our imports would get really expensive and could lead to severe inflation, possibly even hyperinflation. The economic consequences of a scenario like this would be utterly devastating to the average American, potentially leading us into a second economic depression. If you are a student of history, you know that the Great Depression in the 1930s was a very difficult time in U.S. history. Okay, now that I've thoroughly terrified you with this scenario, let's take a step back and see where we are. The 10-year Treasury yield is currently at about 4.2%, up from that September low of 3.8%. If the bond market is truly concerned about this type of a scenario, then they aren't extremely concerned at this point because the yield just hasn't gone up that much, historically speaking. But it is definitely something I'll be watching closely in the months ahead, and I'll keep you up to date on where things appear to be headed. If you're a regular viewer of this channel, I apologize. I haven't been posting as many videos lately. I've had some things that have been on my plate that I've been trying to get off, and it's taken my time. In the new year, you will see a lot more content coming out on this channel. If you want to stay up to date on all my videos as they come out, make sure to subscribe and hit that notification bell down below so you won't miss anything. And if you could do me a favor and hit that like button on your way out to support the channel and help it grow, it would be greatly appreciated. I wish you all a happy holiday season, and I'll see you in the next video.